Welcome to Steep Creeks. This is going to be a quick little video on the difference between residual and latent risk. This is not something you will hear in business school or from the quants. So what is it different? What is the difference between a residual and a latent risk? So residual risk, so the risk they teach you in business school. Historical quantitative risk measures, standard deviation, value at risk, Sharpe ratio, these type of things. What are latent risks? Latent risks are quantified sentiment data. So positioning, flows, market tone, things that are a little bit more abstract, but more real world and more heuristic as opposed to academic. So residual risks are statistical. They deal with the past, the things that already happened. You already know what happened. Latent risks are probabilistic. They deal with the future and they're path dependent. What that means is if there's a trigger, you know how they're going to behave, the agents will behave. So when markets become crowded, any catalyst, what we term as an unknown, can trigger self-reinforcing or self-correcting feedback loops. In market jargon, we call these squeezes or liquidations, right? This is very typical because quant finance always shows us their hand. Their reaction function is very linear cause effect and known beforehand. We know what they're going to do. If X happens, they will perform in a Y manner. So how do we gauge these latent risks? Well, at Steep Creeks at the Delta House, we look at our positioning index, right? What we call the initial conditions. They're the known unknowns. We can't know the unknown unknowns, the catalyst, like Trump coming out today at the end of the day, getting on China again. But we can know the known unknowns, which is what are option gamma dealers? Where is their positioning? What will they have to do? Will they be compressing volatility because their second derivative is positive and they're buying dips and selling rallies, compressing realized volatility? Or are they amplifying volatility because they're in a negative gamma or short the second derivative environment where they're selling downticks and buying upticks, and they're creating a much wider range of prices. And then we look at quant participants like vol control programs, who are simply just 1 over sigma. That's their model. They have certain lookbacks they look at, and when one gets above the other, they take risk off, put risk on, because their goal as a vol control program is they have a portfolio that they want an annualized vol at a certain number, say 10%, right? They're not optimizing for return or return to risk. They're optimizing strictly for risk. Then you have CTAs. They essentially are momentum players. They'll essentially make their money off front month momentum or 1-2 roll yield, but also they size their positions with 1 over sigma. So there you goes another one. Risk parity, same thing, 1 over sigma and 1 over P, which is correlation because it's multi-asset class. But those are much longer lookbacks. And then asset manager equitization is just, you've got an asset, a real money asset manager that is underperforming his benchmark, so he'll buy some futures and to get it back into line with the beta of the portfolio. And then we look at Sharpe ratio to find out, what is the information that's coming in that people are acting upon. And so we look at all these initial conditions and we make judgments about what's going to happen in the future. This was 2 weeks ago. Vol control was at full allocation and CTAs were full allocation. So when we got that Trump tweet on Friday last week, that was the unknown, the catalyst. These guys had to start selling and it expanded volatility and they whacked the market. That's what we look at residual as, latent risk. So here's a picture of what vol control. This was vol control coming into last Thursday, I think it was Thursday night. See, they were fully allocated and they were pretty much fully allocated at the beginning of the year this year. And right before COVID and right before the Fed started raising rates. So what we do at the Delta House at Steep Creeks is we follow these initial conditions or these positions from these active quantitative players. And we say, okay, it's crowded now. So the residual risks are low, but the latent risks are quite high. It just needs a catalyst to trigger it. And that's what we've seen. We saw it Friday, and then we saw it again this afternoon in the S&P. And today's, what's today? Tuesday, October 14th, I believe. Yes. So that's just a quick primer on what we look at the Delta House. We do this weekly in our Zoom, and I update all of the members on what's the positions are looking like, how the market should behave, if there's a catalyst or no catalyst, depending on the crowding and the initial conditions. That's it for today. Quick rundown, but thanks for joining us and see you next time.